Welcome to the Allan Gray podcast. I am Rory Katuska-Jacobson, a portfolio manager on Allan Gray's investment team and your host for this episode. Today, we're going to do a whirlwind tour of the globe, discussing a hodgepodge of shares and investment opportunities to demonstrate where we are currently finding value. As we hope to highlight, this is often an overlooked and unloved spaces. In this conversation, I'm joined today by my colleague, Mark Dunley-Owen. Mark first joined Allan Gray back in 2009 before relocating to Bermuda and joining our sister company Orbis in 2020. Mark is currently a portfolio manager in the multi-asset team at Orbis, where the responsibilities include overseeing the global balanced, global cautious, and optimal funds. Mark, thank you for joining me today. I think this is your first time on the podcast, so maybe just a bit of your background, how you found your way onto the investment team, first at Allan Gray, and then why the move to Orbis.
Thanks, Rory. Good to be here. So I was born in Zimbabwe, going way back, but I left very early. I left when I was 1 year old, and I grew up on a sugarcane farm in Zululand outside Ishawi. And for the first 18 years of my life, I knew nothing about investing. So I literally spent all my time fishing or riding or playing sports. I then went to UCT and did business science. And I loved UCT, but at the end of it, I knew very little about business and even less about science. I got a 2-year working holiday visa, so I got the opportunity to go to London. Went to London, and what I had done at university is I had learned how to code. So I got my initial jobs were coding in banks.
What language was that back then?
That is a good question. I can't even remember. It was nothing like what we use today. But effectively, I was doing IT support for the research team. And after 2 years, my visa ran out, and I was with Lehman Brothers at the time. I was supporting their pharmaceutical analysts. So basically trying to make sense of their pharmaceutical pipeline models. And they said to me, you can stay in London or you can go to New York. So I, myself being young, I thought, let's go to New York. Went to New York. It was frustrating. There I was a true IT support person, which is never what I wanted to do. And then one day I got the opportunity to go and interview with Bear Stearns. And I know these names sound dangerous right now, but at the time they were a very, very well-respected company. And I went for the interview, and luckily the person I was going to interview with wasn't there. So I was interviewing for an IT support job, but that person wasn't there. And then they said, well, do you want to interview for another job? And what had happened is that one of their trading desks had lost their junior guy. And by junior guy, I mean the person who basically fetches the coffee, fetches the lunch, and prints out the documents. And they were desperate. Like traders, when they need something, they want it done right now, and they didn't have anyone to do it. So they said to me, you understand numbers, do you want to do this job?
You're just as good as anyone else to go collect the sandwiches and the coffee.
I think I was better because I was desperate at the time. So I said, sure. And that's how I got to Bear Stearns. And I spent 6 years there learning how to trade mortgage-backed securities. And I will stress, I still knew nothing about investing. Trading is very different to investing. And probably some of my worst mistakes in my whole life were things I didn't do then. So I didn't buy Netflix, which listed then, or Google, which listed then, or Amazon, which listed then. So shares that have done incredibly well over the last 20 years, and I could have bought at the start. Once again, my visa ran out, and I was forced to leave the country. So I came back here, came back to SA.
And that was in 2009,
I think.
So just after the GFC or the global financial
crisis.
Yes,
so luckily my visa ran out before Bear Stearns went bankrupt. So I managed to leave, but I did lose I lost all my stock options. Came back here and I knew nothing about Allan Gray. Never heard of the company. But a recruitment agent suggested I come talk to them, and I did. And I spoke to Ian Little, who was CIO at the time, and he said, sure. I'm sure it wasn't as easy as this, but for some reason he gave me a job, and he said, you're welcome to join us. I said no. I said thanks, but no thanks. And I went and tried to do my own thing for a few months, and then realized that this was just after the GFC, as you say. And so I went back to him and I said, you know that job, is it still available? And he said yes. And so very thankfully, I started working at Allan Gray in 2009. And I started like everyone does, started at the bottom, still knew nothing about investing. I knew a bit about bonds because of my Bear Stearns background, but nothing about equities. And I've been here ever since.
But maybe if you could just contrast the kind of the environment. So maybe if you think about the culture at working at investment banks, working at like a client-focused asset manager with a long-term kind of private shareholder as well.
Yeah, it's diametrically opposite. Remember the first day I walked into Allan Gray, it was so quiet. I was shocked. I was like, does no one talk here? Because Bear Stearns was the complete opposite. It was an incredibly driven, aggressive culture. Coming to Allan Gray, it was very different, but more suited to my style. And I was saying to someone, the 15 years I've been here, what is the most noticeable thing about all our decisions is that we always put the clients first. And a lot of people say that, but really every time we make a decision, we say to ourselves, what would the client want us to do here? And that is unique. I don't think there are many companies that do that. And that's part of the reason we've lasted, in Allan Gray's case, 50 plus years, and Orbisc's case, 30 plus years.
That's a great point, and maybe a good way to then segue into actually just talking about investments, which is really the reason we're here today. So you're fortunate in that you sit in Bermuda, you sit on the global kind of multi-asset team, so you get to look at the whole world. Just in terms of, how you see the lay of the land today, where are you seeing opportunities? And maybe you can talk to some of those geographies or shares.
Let's start with where I don't see opportunities. I think if you look at the world at the highest level, so you look at market indices, I think a lot of them look stretched. I wouldn't say that they're definitely not extreme. So the US is the biggest market in the world, and it's the one everyone talks about. And we look at it in various ways. And on most of those metrics, it looks high versus the last 30, 40 years. And historically, if this is your starting point, you've done poor to average going forward. So history suggests this is a bad time to own the market. Now, this time might be different, but if history rhymes, I would be cautious. Having said that, the great thing about a global universe is that there are so many choices out there. And so we look around the world and we say, well, we don't want to own the indices. What can we own? And there's a variety of things we like. I mean, if you stick in the US, there's a few things one should note about the US. Everyone talks about the US as one economy, and that's certainly not the case. For example, right now, 10% of the US consumers account for 50% of US consumption spend. So basically, the US economy is being driven by the rich people who have assets. That is probably not sustainable. Another way to look at the same point is to say, well, there's a perception that the US economy is doing particularly well right now. If you look at the S&P is more than doubled since 2019, right? So since pre-COVID, it's more than doubled. Yet if you look at real indicators, so one example could be truck volumes. So volumes that are being transported around the US in trucks, those are lower today than they were in 2019. You look at cardboard box volumes. Those are falling right now. So all of these metrics, which are real things, like you can't game volumes. Real things suggest that there's a large part of the US that is actually struggling today. And that presents us with opportunities because we can then look at the stock market and say, are there companies that are exposed to the parts of the US that aren't inflated, where expectations are quite low, and can we invest in those? And we found a handful of those.
Maybe if we just take a step back, I guess, to your earlier point around kind of how well the market is done, I guess part of that is increasing concentration in a handful of companies that I guess one could also argue are global businesses that happen to be listed in the United States. So here I'm talking to the likes, of Meta, Apple, Microsoft. These are phenomenal businesses that have grown exponentially over time, but increasingly so they generate as much, if not more revenue offshore than they do in the US. So how do you think about that element? And I guess in distinguishing between how the US economy is doing versus how the S&P 500 is doing, driven by a basket of arguably global businesses. And then maybe the second thing just to touch on before we get into individual shares, that if I pushed back against the narrative and said, well, one of the reasons box sales or vehicles could be under pressure from a logistics perspective, is there a structural element to it where people's consumption behavior has shifted maybe to a more online economy where I might purchase fewer goods, but I'm consuming more games online or something like that?
I mean, there are definitely global businesses, but a large part of their revenues still come from the US. I guess the point is people will look at it as a percentage of the S&P, and that's probably simplistic. So you should look at it as a percentage of world capitalization. But even if you look at it, if you use another lens to look at it, if you look at the valuations they are on today, the speed of the growth in prices over the last 3 years versus their earnings, expectations look high, so they look stretched. I don't worry about the fact that they list in the US, but they have global exposure. On the second point, has the mix changed or has the economy changed? Yes and no. So on the truckload point and truckload volumes, you can look at certain metrics that take out the impact of Amazon. So you say Amazon does all its own logistics, right? So that impacts the time series over time. You can take that out and the numbers still look similar. Are people consuming less stuff and more experiences? I think that's potentially true, but I would say they definitely buy more stuff in cardboard boxes than they did. I mean, I'll go back to when I was in New York, right? And I said I missed the opportunity to buy Amazon. I remember I started ordering from Amazon, and I'm really dating myself here, but my doorman had never seen these things before. And he was wondering what I was buying online. And you go to a building in New York today, and it's just flooded with Amazon boxes. So the world is definitely, the use of cardboard boxes has gone up. So I wouldn't be too worried about that. But I take your point that more money is being spent on things we can't measure, less tangible things than historically.
Okay, I mean, the other interesting thing, just on your anecdotal example, it also strikes me how when I grew up, you used to watch these kind of traditional cartoons where there was a milkman delivering milk. So it felt like, at least in the cartoons, groceries were getting delivered to doors all over the world. And then there was the advent of the likes of Walmart, these massive retailers that came and kind of completely displaced all of the traditional retailers. And suddenly everyone was venturing very far to buy discounted goods. And now we've shifted back as an economy to getting everything, but at a much lower price delivered to your door.
I mean, I've had this debate over the last 5 years of whether online food delivery was sustainable, because as a concept, it's so weird, right? Like you're too lazy to either walk or get in your car and drive 5 minutes or walk 5 minutes to pick up your food. So instead, you get it delivered to you and you pay for that. You either pay via a delivery fee or it's implied in the price. But, and yet people do that because people crave convenience. So if you go back to caveman times, there was no convenience. And over the last few centuries, we've moved towards the more convenient state over time. And anyone who finds a business or product or service that improves convenience, I wouldn't bet against them.
That's a very good point. Okay, where are the individual stocks where you're finding value in the US?
Let's start with an example that, if we go back to COVID times, we bought it during COVID. It is a movie theater chain. Well, there's two. One is called Cinemark, which South African listeners probably have never heard of. The other one's called IMAX, which everyone's probably heard of. It's large format movie theaters, right? And when we bought them, we probably bought them in 2021. And I remember I read a broker report which did a survey. So it surveyed a whole group of people and it asked them questions like, will you fly again? Or how likely are you to fly again? And you could rate 1, very likely, all the way to 5, very unlikely. Will you go to a restaurant again? Will you go to a movie theater again? And I was amazed. The survey implied that most people wouldn't do this again. And I was like, you won't fly again? How are you going to get around the world? But at that time, that was the feeling at the time. People were so focused on COVID that there was this belief that things would never change. And what I did agree with is that I would never go to a movie theater again. Because the idea of going and sitting in an enclosed room with 100 or 200 other people on dirty seats or German-infested seats just wasn't appealing at the time. And that was priced into these stocks. These stocks were priced to be in terminal decline, both Cinemark and IMAX. What has happened since is the complete opposite. And at the time, the analyst who covers these companies, his name is Jeffrey, he had the view that, you know what, movies are the cheapest form of communal entertainment out there. They are going to be around forever because they cost about, in the US, for $20, you can get a movie ticket and popcorn and a drink, right? You can get together with a bunch of your buddies, you can go out and have a night together and you can share an experience. There's no way to do that for that price doing anything else in the US. And so his view was that demand would come back. At the same time, if you remember during COVID, there was a lot of optimism around streaming services. So there was this belief that Netflix would take over the world and Disney Plus, Hulu, and all these other services. And they would start releasing movies directly to TV. So they would skip out the box office window. If one thinks about that, that's impractical. For the simple reason that by far the majority of revenue on a new release comes from the movie theaters. So if you skip the movie theaters, you don't make your money back. To the extent that Netflix, for its first few movies, made losses on those, right? And so if you take those two things together, then the thesis was that demand would recover and supply would be rational and return to the movie theaters over time. And those two things have happened. Now the shares they did well initially, and then they've been weak recently because we still haven't had a full year of normalized box office releases, because I don't know if you remember, there was a Hollywood strike.
That's right.
About 12 to 18 months ago, and that's still feeding through the system. But we think next year, 2026, you can see the slate, right? You can see what movies are going to be released. And there's a long list of what look like very high potential movies. A lot of them are sequels. So we expect next year to be a very strong year for the box office. And if that's the case, these companies have become very disciplined on capex, very disciplined on costs, so that revenue is going to feed through directly to the bottom line. And they're on multiples that are not challenging by any measure. So those are the sort of things we look for. And given the size of the use, we can find enough of those to still remain invested there.
It's amazing how when you talk about this human desire for kind of a shared experience, it reminds me a little bit of one of the most popular movies yet to date has been the Minecraft movie. And not that I'm encouraging this kind of behavior, but there's a particular scene in the movie where one of the characters says chicken jockey, and suddenly the whole audience goes absolutely mad and starts throwing their food and their drinks in the air. And that became an absolute craze earlier in the year and really drove footfall to the cinemas just for people to have that kind of shared experience.
Yeah, it's happened a lot, right? So you think about the Minions, everyone dressed up as Gru. You think about when Barbie was released, they did a sing-along version of Barbie, and they also did I don't know if you heard of K-pop Demon Hunters that came out.
Unfortunately, I have.
I love it. It's a great movie. But it came out a few months ago, and they now do sing-along versions of K-pop Demon Hunters. So they go there, and you can do karaoke to the movie. And they've sold out. They've sold out all the showings. So it does show that people want to, as you say, they want to share experiences.
It is remarkable. And then just maybe while we're still on the US, are there other pockets of value that you're seeing in the US?
Yeah, so what I mentioned earlier about delivery volumes, cardboard box volumes, those sort of companies look reasonably priced, if not depressed. In fact, I'd say they're depressed. And some of these, we've known them for years. It's what's called the XO stable.
Yes.
That basically means there's a lot of companies with a letter and then XO, so, or some version of XO. So XPO, RXO, QXO, GXO.
And maybe just kind of highlight what the shared commonality amongst the naming of all those companies is.
They've all started/run by a person called Brad Jacobs. And Brad Jacobs has an exceptional management track record. He has started a number of companies over time and built them from nothing into billion-dollar businesses. He started a company called United Rentals. He started XPO initially. XPO is where all these grew out of. And then he split them over time into GXO and RXO. Then he recently started the most recent one, which is called QXO. He's written a book, if anyone interested, it's called How to Make $1 Billion, I think, which is a terrible title, but it's a good book. And we know Brad Jacobs quite well. He has delivered a lot of value to our clients over the years. We understand what his goal is. And what's interesting about particularly RXO, GXO, and XPO right now is that if you look at them on the metrics you see every day, they look expensive. They're not making much money right now. They're on high multiples. So the average person wouldn't see them as cheap. We have a view on where they're going. And based on that view, we think the earnings are going to dramatically inflect over the next few years, particularly because the base is low right now. What I said about activity is low, that translates into very low earnings for these companies. But the supply is leaving the market. It's becoming more rational. So we expect earnings to grow materially over the next 3 to 5 years. And the quality of the companies to be fully understood, because right now they're not perceived to be quality companies. If that's the case, you're going to have earnings growth, you're going to have multiple growth, and we think there's substantial upside to all of these shares. Now, it's definitely taken longer than we initially thought, and the downturn, if you speak to people who understand transport, they will say the current downturn in the US is as bad as they've ever seen. So that's probably the worst downturn in the last 20, 30 years, which is, you never hear that when people talk about the years, but there's definitely parts that are depressed. Now, let's say we're wrong, and the risk here is that these are cyclical companies. So there's a perception that if the US economy weakens, we have a so-called recession, they will suffer the most. That's a valid risk, but the flip side of that is they're already trading on a low base. So our view is that potentially, if there is a recession, the expectations are low enough already that they may not fall as much as the market. So actually, weirdly, they may actually protect value on the way down, and they may add significant value if we're right about the upside.
And then I guess one of the distinguishing factors when I look at the Orbis portfolios is broadly they are underweight the US and overweight most other markets, which suggests that you're seeing a lot of value outside of the US on a relative basis. So maybe if we just expand the kind of lens a little bit, what other geographies or markets are you seeing value in?
I think there's value in most markets if you look at certain sectors. I mean, let's take the UK, for example. Now, the UK is largely ignored by global investors because it's quite small, and except for the global companies such as the miners and the banks, outside of that, people tend to ignore it. But there are some truly high-quality companies there. If we think about, we haven't talked about AI yet, but for AI to work, you have to build a lot of stuff. You particularly have to build a lot of data centers, which are basically just big buildings with a lot of computers inside. To build a building, you need someone to manage the project, do the construction, and there are companies in the US that are exposed to that in some way. There's a company called Keller, and what Keller does is geotechnical engineering. And what that means is they look at the ground. Before you start a building, someone has to survey the ground and say this is structurally sound, you can put in the foundations. I don't know if you remember when the Gautrain was built, which must be 20 years ago now, if not more.
Well, it started 20 years ago.
Oh, did it?
Didn't finish 20 years ago.
But they had geotechnical problems, right? They didn't appreciate the challenges underground. And Keller's job is to avoid that. Keller's job is to go in first, do the geotechnical work, and make sure the project can proceed with as few surprises as possible. That work gets done no matter what. You can't start a construction project until you've done that. So they are first in line for any payment. And they are one of the few companies in the world that can do that. They happen to be listed in the UK, so no one's heard of them. They're quite a small company. But they trade on a single-digit multiple. Now, that's an opportunity for us, where we can find a company that's good in its niche, no one's heard about it, and reasonably priced. There's a similar one called Balfour Beatty, which is a bit bigger, and it has doubled recently, so it's not as cheap as it was. But it's the same idea. It's a business with a lot of US exposure, very good at certain things, involved in construction, happens to own quite a few infrastructure assets. And depending on how you view the value of those infrastructure assets, you could argue that the share price is completely covered by net cash and by those assets. So you're getting the construction business, which is a major world leader, basically for free. Now, you won't get any of those equivalents in the US. They're just too well understood. But in the UK, you still get those sort of opportunities. Each of the smaller countries in the world tends to have these sort of opportunities. I mean, you would know this well from your world, right?
Yeah, that's right. So you touched on kind of almost AI adjacent businesses. And I'm going to try to say AI as many times as possible now because I think that'll probably drive up our listenership. But beyond the obvious names, which I think are over-owned, are there other AI adjacent themes or ways you've looked to kind of take advantage of the potential AI opportunity without necessarily paying up for that opportunity?
Yeah. So you need to think about, I mostly work on what's called the Global Balance Fund, right? And recent performance has been very strong. All clients ask me right now, what has driven that performance? And my answer is that you have to look at what's happened over the last 5 years. This didn't happen overnight, right? And if you go back 5 years, the head of our team is someone called Alec Cutler. Alec Cutler is an engineer. He has been looking at the industrials, utilities, semiconductor space for longer than most people have been alive who are investing today. He's seen previous cycles. He understands his business better than most. So 5 years ago, he started buying these companies that he believed were critical to a country's future. The easiest one to discuss are semiconductors. So there are various companies out there that make semiconductors. The most well-known one is a company called Taiwan Semiconductor, or TSMC. But there's Samsung in Korea, there's Hynix in Korea, there's Micron in the US, and then there's a slew of other ones that people don't know as well. And we started buying those 5 years ago. And for the first few years, we were wrong. They didn't do particularly well. But over time, people have realized that for AI to work, you need semiconductors. You need a lot of semiconductors. And the headlines always focus on NVIDIA. And NVIDIA makes the leading edge semiconductors called GPUs that are used in data centers. But when I say makes, they don't actually make them, right? NVIDIA makes nothing. They just design them. TSMC makes them. So the better NVIDIA does, the better TSMC does. And that theme echoes around our portfolio. We own various companies that the more money is spent on AI, the more capex is spent on building out these data centers, the more that flows into their revenues, into their margins, and into their intrinsic values. And that's a wide range. It ranges from TSMC to Samsung to the company that makes the copper cables, the power cables that are needed to get the power from the plant to the data center. And what's interesting there is that industry has been so boring and so ignored for 20 years that there's only really 3 companies left that do that. And they all happen to be listed in Europe. That's weird, right? Like most leading businesses are in the US, but it just shows that there was no appetite to invest capital behind what was considered a boring business. And so now there's a comfortable oligopoly between these 3 companies, and the world suddenly needs a lot more power. And to get the power, they need power cables. And you can imagine what's happening to the economics of these companies and subsequently to the prices. That's driven a lot of our performance over the last 1 and 3 years. But the seeds of that performance were germinated 5 years ago.
I mean, it is remarkable if you're willing to do the work, how many kind of AI adjacent themes that you can actually do, in the sense that, so you've spoken a little bit to semiconductors and a little bit to cable providers. But within that, you can say, well, okay, well, where does that copper come from? Should we look at some of the miners? And at points in time, some of the copper producers, I imagine, have been incredibly cheap.
Yeah.
And these are incredibly energy intensive warehouses that you need that store all of these semiconductors, which are kind of the brains or the engine behind AI. So do we look at the energy theme, for example? And I know Orbis over the last few years has played that energy theme through a multitude of different lenses. Are you still finding any energy names attractive at this point in time?
Yeah, so as you say, we have played it. What's important to note is that our portfolio is constantly evolving to areas that are less appreciated. And so we started off buying oil companies. Shell is a good example, right? That was when oil was very low prices during COVID. Over time, those companies became more appreciated, so we started buying natural gas companies because we believed at the time the natural gas was, and we still believe today, the natural gas is a cornerstone of energy globally, but more importantly for the US. The US has an abundance of natural gas. It's cheap, it's readily available, and it's the easiest fuel to use to generate electricity. But 3 years ago, that wasn't commonly believed. People believed that natural gas was in decline. It was a fossil fuel. It emitted carbon. So they believed it had a finite life. We had a strong view against that. So we started buying natural gas theme names. And some of those we still own today. So the biggest one is a company called Kinder Morgan. And they own natural gas pipelines. And basically what they do is they move natural gas around the US. And what's important there is once you have a pipeline, you have a very strong moat. It's a bit like building a railway. Once you have a railway, no one's going to put a railway next to you because it just costs a lot of money to build, and the economics don't make sense if someone's already there. And Kinder Morgan's got this network of gas pipelines around the US that if you tried to build it today, you just couldn't. It would cost so much money. The regulatory red tape would be so extreme that no one can replicate the assets. And so you have an asset base that we expect to generate reasonable returns. The company's not going to do incredibly high returns, but it's going to generate reasonable returns over a long time period. So that's a great share to own in a balanced fund where we're looking for reasonable returns over long time periods. We own Kinder Morgan. And then the other parts of the energy spectrum as well. We looked at nuclear recently. If you believe AI demand is sustainable, which we do, then one of the most important things they need is 24/7 baseload power. So power that's reliable all day, every day. Solar doesn't do that. Wind doesn't do that. Gas can do that, but it's expensive the way to do that. The 2 fuels that can do that most reliably are nuclear and coal. And so we started looking at the nuclear names. Unfortunately, there aren't many of those, and they ran really hard. So we bought some, and literally they went up 3 times in a matter of 2 months.
These are more the utility businesses, the power producers, as opposed to the providers of uranium.
It's even one step more removed. It's the companies that build the equipment that are used in nuclear power plants. So if you're going to build a nuclear power plant, you need a reactor. someone does it. Westinghouse does that in the US. They're privately owned. But you're also going to need the casing of the reactor. You're going to need all the equipment that goes around. You're going to need the actual turbine that generates electricity. In the world, there are some companies that do that. The ones that do it well are Chinese or Russian. You can imagine America's not going to use a Chinese or Russian nuclear equipment provider. So there are very few that do it in the Western world. In fact, there's only two of them, or two main ones. And one of them is called Doosan Enerbility. They're listed in Korea. One of them is called BWTX. They're listed in the US. And we own both of those, but we own less than we would have liked because the share prices ran ahead of us. We're still monitoring them. We hope that we get another opportunity. We think they are incredibly well placed over the next decade plus as the Western world returns to nuclear power.
I mean, interestingly enough, one of the ways we've kind of looked to play a similar theme in the Frontier Fund is through owning Kazatomprom, which is the uranium producer based in Kazakhstan. And for kind of similar reasons, they're bottom of the cost curve, incredibly cash generative. And if you take a longer term view and you think the uranium price could actually rally from here, today it's trading on kind of an undemanding multiple of 8, 9, 10 times free cash flow. It's also been a good share to own, but we continue to own it.
Have you looked at Cameco?
We have looked at Cameco. So this trades at about a third of the valuation of Cameco, with, I would argue, better quality assets. And actually, the way the ownership structure for a number of these assets works is if you look at the underlying mines, very often Kazatomprom and Cameco are joint shareholders in that mine. So for about 60%, broadly speaking, about 60% of Cameco's portfolio, you're actually buying the same mines.
That's interesting. I wanted to look at Cameco because I mentioned Westinghouse. Westinghouse is this business that went bankrupt 5-10 years ago and was bought by a company called Brookfield. They are a private asset manager. Not private, but private asset manager. They manage private assets. And this business has, in today's world, Westinghouse has got a unique position. They can build reactors in a country that is increasingly shifting back towards nuclear power. Brookfield sold half of Westinghouse to Cameco 3 years ago. So I was hoping that the value of Westinghouse would not be reflected in Cameco shares. But as you say, it's hard to justify the valuation of Cameco, particularly when you compare it to the other options out there.
Yeah, and that must be a significant proportion of the difference between them and Kazatomprom then.
Yeah.
You've touched a little bit on like geopolitics with your reference to Russia. So maybe if you could just touch briefly on your view on China. Are there investment opportunities? Do you think it's too hard for a Western investor to invest in China at this point in time? Are tariffs going to make it a very difficult place to invest?
Sure. So we do have some China exposure. We don't have much, I'll be honest. My view on China is that it is such a big part of the world economy today that it cannot be ignored. So there's a perception that it's uninvestable or that the US is going to decouple from China. I think that's nice in theory, but practically impossible. But for the US to decouple, their supply chains would just fail. So I think you have to look at it and say, I think China is going to be around. They're going to be part of the world, and they're going to be an increasing part of the world, because the other side of it is that there's a handful of industries where they are by far the world leader. They're by far the best in the world. And it's tough to see the US ever catching up in those industries. So I don't think you can ignore it. And then the question is, there's definitely risks. I mean, it's a state-controlled economy. I think it's fair to say they're enemies with the US, and increasingly so given the way the US administration is going. Most of our clients live in the Western world. So there are scenarios where one can lose a material amount of value by owning Chinese shares. And we're very aware of those risks. How we manage that is we try and look for companies that are, well, so far we look for companies that have very low geopolitical exposure. And that tends to be Chinese companies that sell to Chinese people, and tends to be companies that are more consumer-based. That has two advantages. One, it takes out a lot of the geopolitical risk. So some of these companies, if the US and China relations worsened, it wouldn't really matter to them because their supply chain is within China, their customer base is within China, their brand awareness is within China. The other attraction is that the Chinese consumer is very weak right now. It has been weak for a few years, mainly because the property cycle has corrected. They went through an incredible property boom/bubble, and that has been allowed to normalize. It's extreme, so it's taking many years to normalize. But to me, it feels in some ways similar to how the US felt after the GFC. Coming out of the GFC, there was perception that the US property market would never recover. It was dead and buried. And that turned out to be one of the best opportunities to buy US shares. If you had bought Microsoft in 2012, you could have gone to the beach for the next 15 years. And I'm not saying China is the US. It's definitely not. But there's a similar sort of sentiment there right now. There's a belief that the Chinese consumer will stay weak forever. And if you visit China, that's just not true, right? The Chinese consumer is vibrant. They are spending probably less than you want them to, but there are things happening in the country. And so there are shares you can find. And the best example is a company called Anta Sports. And they are one of two big Chinese sportswear producers. So the easiest way to think of them is that the core business is very similar to what Americans would call Nike, what South Africans would call Nike. They have a very strong presence in China. More importantly, they actually own a portfolio of brands. So they don't just own one brand. They don't just own Nike. In their case, Anta is their biggest brand. But they also own 5 to 10 other brands, each of which focused on a particular niche. What they tend to do is they tend to find a global brand. There's a brand called Fila, which some people may know. It's owned by a South Korean company. It's quite strong in the tennis world. They bought the Chinese rights to Fila. There was zero Fila awareness in China. And over the last, 10 to 15 years, they've rolled out Fila to the extent that it is their second biggest brand by a long margin.
Oh, wow.
And they've made it more fashion focused. So you have a brand that Chinese people consider to be I would call it the Uniqlo, but they said that's wrong. I asked
more the Lululemon.
They actually have a brand called Maya, which they're trying to make the Lululemon of China. Okay. So they have, for each of these niches, they have a brand. They also own, anyone who follows outdoor brands, they own a brand called Arc'teryx, which is a very high-end outdoor jacket brand. And these jackets are crazily expensive, but people almost treat them like a luxury good as opposed to like a consumable good. So they seem tremendous interest and growth there. They've bought a German company called Jack Wolfskin, which I know because I actually bought a Jack Wolfskin tent many years ago, but it's been completely ignored. So they've bought the brand. They don't pay a high multiple for it. And then they expand the brand, put it into their platform/network, and they roll it out across China. They've done this incredibly well time and time again. There's no reason to expect they won't do it well again. The other things we look at is management. The founder's still heavily involved, still owns lots of shares. The culture, very long-term focused. The economic history is exceptional, like truly exceptional. This is like, if I didn't give you the name of this, you would think this is the world's greatest consumer company. It really is a high-quality company. And yet it trades at, let's say, 15 times earnings. Nike, which is a much worse business, trades at 30, 35 times earnings, right? Adidas, which is even worse than Nike, trades at a similar multiple. So you buy a better version of Nike at half the price. That's really why we own the Chinese shares, not because we have a view on geopolitics. It's because we think the opportunities there that you just can't get in the rest of the world.
That's a great point, and maybe a good way to end. That last point you've made is incredibly valid, Mark, in the sense that when it comes to investing, the single most important variable is the price you pay. And, in our universe, as we've kind of articulated with some of the examples you've demonstrated, often you're being compensated for taking that risk by paying a much lower price. But if you can find a higher quality business that's entirely focused on the local consumer, so therefore some of these risks are misplaced, then you can really get a kind of the best of both worlds where you're being compensated for taking a risk that may not even exist to begin with.
I think so. And the nice thing about a global universe is there are those opportunities. You can buy a company that you say is actually a quality company, priced like a company in decline. And one of my favorite investing books is called There's Always Something to Do. And that's my belief. If you look around the world, in the investing world, there's always something to do.
Thank you to Mark for joining me in this conversation. Today we discussed a number of different investment ideas, highlighting the wide array of opportunities you can find in less popular and less familiar places. This included markets that are familiar with most of us in the US, but we also touched on a number of other geographies, including surprisingly interesting companies in Europe and one or two companies in China. If you would like to get in touch, please send an email to info@allengray.co.za. You can subscribe to this podcast on your preferred platform to be notified of new episodes. Lastly, Allen Gray is an authorized FSP. To view our terms and conditions, please visit allengray.co.za. Until next time, I am Rory Katiska Jacobson. Thank you for listening. This podcast was produced by Volume Podcasts.
There's a song that goes, "Money can't buy me love." And that's true. But then they told us all you need is love, which anybody with a mortgage will tell you most certainly is not true. Love won't pay your parking tickets or your student loan. It's also needy. It requires effort, availability, constant care. But more importantly, love requires time. And while money can't buy you love, it can certainly free up some of your time. Time to spend on the things you love, with the people you love. And if you're looking, maybe even time to find the one you love. That's why, after 50 years of investing, we've learned that time is the greatest gift of all. And the good news is, if you invest early, time gives you money. And then money gives you more time to do the things you love. And don't you love that about investing? Ellen Gray, long-term investing. Ellen Gray is an authorized FSP.